Bitcoin ETF flows had a very confident Thursday. Friday reconsidered. Farside data show US spot. Bitcoin ETFs swung from a $233.1 million net inflow on July 30th to a $265.4 million net outflow on July 31st. That does not predict Bitcoin's next move, but it gives us a clean reason to map the three paths that matter now. The late July tape was already unstable before that reversal. Using Farside's daily totals, the 7 trading sessions from July 14th through July 22 added about $999.3 million, while the next 7 sessions from July 23 through July 31 lost about $526.7 million. On July 31st, the red numbers were spread across IBT, FBTC, BITB, ARKB, and GBTC. So this was not just one fund having a bad afternoon. Institutional money, it turns out, also owns a reverse gear. ETF Flows Matter because the wrapper is connected to actual Bitcoin inventory through the creation and redemption process. SEC filings show authorized participants can create or redeem baskets, and current trust structures can involve delivering Bitcoin to the trust or receiving Bitcoin back from it. That makes ETF activity one important marginal demand and supply channel, but it is not the whole Bitcoin market. Global spot demand, derivatives positioning, leverage, long-term holder selling, and macro liquidity can all change the price response. The base case is boring, which is often market language for useful. If ETF flows keep flipping between green and red, while Bitcoin refuses to follow cleanly in either direction, the market is probably still absorbing those flows rather than being controlled by them. Bitcoin was still on track to finish July about 7.5% higher, even after slipping below $63,000 on Friday, a useful reminder that weak ETF days do not automatically produce a broken market. In that scenario, one daily print is a vote, not a constitution. The bull case needs more than one heroic green number. I would want to see several positive ETF sessions, followed by Bitcoin actually strengthening when that demand arrives, especially during the US session when the funds are active. That combination would suggest marginal demand is again absorbing available supply instead of merely showing up on a spreadsheet. The key is persistence plus price response, not a single large inflow that disappears 24 hours later. The bear case is the mirror image. If net outflows continue for several sessions and Bitcoin starts weakening with them, then the July 31st reversal becomes more than noise and starts looking like a fading support channel. The evidence gets stronger if US sessions repeatedly fail to absorb selling and the market cannot stabilize even when broader risk conditions are calm. Friday alone cannot prove that story because one red ETF number is evidence, not a prophecy. There is also a fourth possibility hiding inside all three scenarios. ETF flows may simply stop being the dominant variable for a while. Markets are very considerate that way. They change the test while you are still grading the previous one. A major macro surprise, a regulatory event, a large corporate Bitcoin transaction, or a derivatives liquidation can overwhelm the ETF flow that looked important the day before. Even the same $200 million can matter very differently depending on available liquidity and how much leverage is already sitting in the system. So the next move is not to guess whether Friday was bullish or bearish. Watch two things together: whether ETF flows persist in one direction and whether Bitcoin confirms that direction with price. If inflows return and price strengthens, ETF support is rebuilding. If outflows persist and price weakens, that support is fading. If flows stay ugly and Bitcoin holds, then the ETF channel is not running the whole show. ETF demand is support. It is not a seatbelt.